How bank statement loans actually work. A lot of self-employed borrowers think if their tax returns don't work, they're automatically screwed when it comes to buying a house. That's usually where the entire conversation around bank statement loans start. Because one of the biggest misconceptions in the mortgage world is that every borrower has to qualify using traditional taxable income. That's just not true anymore. And bank statement loans became one of the biggest products in the non-QM world because lenders started realizing something really important. A lot of self-employed people make good money. They just don't show it traditionally on paper. That's the key difference. Because think about how most business owners operate. They write things off. They deduct expenses. They reduce taxable income, which is all normal. But then when they go to apply for a conventional mortgage, suddenly the lender is heavily focused on net taxable income after deductions. That's where things start falling apart. Because somebody can have strong deposits, strong cash flow, money in the bank, excellent credit, and still look weak conventionally because their tax returns got compressed by write-offs. That's exactly where bank statement loans come into play. Instead of focusing primarily on tax returns, lenders start analyzing actual bank deposits and cash flow patterns instead. That's the major shift. And most bank statement programs usually work off either 12 or 24 months of business or personal bank statements. Now, this is where people get confused. The lender doesn't simply total up every single deposit and call it income. There's still analysis happening. They're looking for consistency, stability, business cash flow patterns, deposit trends, and depending on the scenario, lenders may apply expense factors too. That's a huge piece borrowers or people don't understand. Because if you own a business, the lender knows not every dollar deposited equals pure usable income. There are still operating expenses most of the time. So many lenders either apply a standard expense ratio or use CPA letters or analyze business expense percentages differently depending on the file. And this is why lender selection matters so much in the bank statement world, because one lender may calculate usable income very differently than the other lender. That can completely change the approval. And by the way, if you guys are into conversations like this, real estate, investing, DSCR stuff, non-QM, definitely like and subscribe because I'm going to be talking a lot more about this kind of stuff. Now, obviously, these loans still have underwriting. This isn't random, easy money lending. Credit matters, reserves matter, down payment matters, cash flow stability matters. And reserves become really important in the non-QM world overall. Lenders love seeing liquidity, especially with self-employed borrowers, because reserves help demonstrate stability if income fluctuates seasonally or month to month. And another thing people underestimate is how much documentation still matters. The cleaner the deposits, the cleaner the business structure, the easier the file usually becomes. If deposits are all over the place, mixed heavily, between business and personal, inconsistent, hard to source, things can get complicated pretty fast. That's where experienced loan structuring becomes really important. I think bank statement loans are becoming more and more important because the workforce itself changed dramatically. More entrepreneurs, more business owners, more commission income, more self-employed borrowers. The economy became much less traditional. But for years, underwriting still expected everybody to fit inside the same W-2 box. Bank statement lending evolved directly out of that disconnect. And what's interesting is some of the strongest borrowers financially are actually perfect for bank statement candidates. Or actually are actually perfect bank statement candidates rather. They're not weak borrowers. They're borrowers whose income simply just looks stronger through cash flow analysis than through tax returns. That's a massive distinction. And once self-employed borrowers finally understand how these programs actually work, the conversation usually shifts from, I probably can't qualify to, wait, I might be able to qualify.